Well, let's hit that right once I hit the record button, right? Well, welcome everyone. This is Portfolio Growth. I'm Jake Pelly, and as always, here's our fun disclaimer. As always, this is being recorded so you can review it at your leisure once I post the replay. How's everyone doing today? I'm doing pretty good. It's good to see you all here. Just click. Thank you. I was struggling at spelling today, apparently. You know, the one day I decide, you know what, I've been adjusting my sleep schedule all for the past 2 weeks to get used to the baby, taking the kids to school, picking them up from school. I'm going to take a nap today. The market looks okay-ish. It doesn't look like it's going to fall off a cliff, and then it fell off a cliff. So, you know, that's just the market for you. The Dow was down 1.27, NASDAQ down 2.21, and the S&P 500 is currently down 1.29. Now, if you joined me at yesterday's market recap, you'll remember that I talked about if TLT cannot hold this 115 level, it's going to dip further. Where is it going to dip down to? And we talked about this yesterday during the market recap, and I have the video posted if you want to see it. It's going to dip down potentially to the 113. And if it fails from this level, it's looking like it might go back down to the 107. From if we have to go all the way back to a monthly candlestick for that. And 2014 is about the area it looks like it could dip down to further if it continues here. Now, it is looking pretty attractive yield-wise for most fixed income right now because it is getting a little bit higher there. You can see not only do we gap down, but we are retesting this level right here where we drew as the next area potentially for it to drop down to. Now, if it continues to drop here, it can drop significantly lower. What does have me concerned is for TLT, volume is picking up to the downside. Now, it does look like it is retracing a little bit in a 2-minute chart. If we go look at that real quick. You can see right here in the 2-minute chart, it does look like it is coming back a little bit, but it is rounding here. Now, understand that there is going to be a rotation from fixed income out of riskier equity into the safety of higher yielding safe debt. Now, high yield debt is anything below Moody's BAA rating or S&P 500 BBB rating. High yield debt's getting crushed too, and it's probably going to continue to get crushed here as yield continues to rise in the 10-year. You can see the 10-year is steadily above 3.189, the 30 years at 3.34. Why is the 3% yield significant is because of dollar depreciation. Every year the dollar depreciates about 3%, 2%, depending on the year it is, and that tells us that bonds are now yielding higher than the dollar depreciation and rate of inflation. So bonds are starting to look attractive to investors because you're now actually starting to get a return on them. So keep that in mind as yield continues to move up here, and the Federal Reserve wants to raise rates one more time this year and 3 times next year, and they removed the accommodative phase phrasing in their statement, saying that they are above the neutral line anyhow and they want to move it up a little bit higher. Remember, normal healthy bond yield in the United States is around 5%. We're currently at 3, so that tells us we have about 2 more percentage to get here. And as that continues to rise here, equity is most likely going to be a little weak because of that. You can see today in the S&P 500 heat map who is actually not doing very well, and that's majority of the sectors. Now, banking is a little wonky. Lilly and Company looks to be okay here. Utilities looks to be a flight to safety there because of yield. Property and casualty insurance is looking to be okay. So pretty much your risk off, like property and your life insurances, utilities look to be okay, and some outliers like Lilly and McDonald's and like Starbucks looks to be holding the trend. But overall, Microsoft down, Facebook down, Amazon down. We talked about this yesterday. I did think it was a little bit overextended, and so goes FANG, so goes the market, and you can see FANG is getting hit pretty hard today. Amazon, because it turns out there's some chips in their servers that can be corrupted remotely through some espionage. It's the BMC chips, and why that's important, because it's hardware, not software, and if you have hardware that's able to corrupt code, you have a really hard time getting rid of that in your servers. And when I mean a really hard time, I mean you have to replace the whole motherboard, because the whole code and kernels have been corrupted, and that's not very good. And it affected Apple too. Just two big names here, and you can see that Daniel had a pretty good link to that right here. He had a good talk about that story. So, pretty interesting to see here. And if it's true and it's affecting a lot of those products, it could be a problem, because that means people can remotely access your phones, your servers, and Amazon is a majority of the cloud provider here in the United States, or server provider, and if that's true, that means a lot of the people that have their content on their cloud could be at risk too. So big problem for Amazon, and that's where they make a lot of their revenue year over year, is the cloud-based services. So Amazon's going to get hit pretty hard with that. So keep that in mind. It's actually a pretty big deal to have that chip be a problem in their server. So it could dip down a little bit further, so be very careful here. But again, let's go back to bonds. So if bonds continue to yield higher yields, TLT is going to go down in price, because bonds share an inverse relationship with each other. As yield moves up, bond price moves down. So, if the Fed plans on increasing yield, excuse me, it should be reflective in the bond price. So let's keep that in mind. If parity is 100, one bond equals usually about $1,000. If the yield moves up, you get the bond at a discount, because the bond price goes down. If the bond price goes down, you get the bond at a premium. If the bond yield goes up, you get it at a discount. Think about it as a teeter-totter when it comes to bonds. They go over it very well during the course for the Series 7 about bonds. Bonds are actually covered very well in that. And as I said always, if you have not had the chance to pick up a used Series 7 manual, there is a wealth of knowledge in it, and you can get it for like 14 bucks used on Amazon. And it goes over a lot of information that you might be a little bit gray on. If you're new to bonds and how bonds work, there are a lot of them, and the Series 7 will go over how a majority of them will work. So just take that into account. Let's see if I can actually find it here. There we go. Now this is a sneak peek on something I'm working on, but we can go over just a little bit of it. These are most bonds you can buy. There's corporate bonds, high yield bonds, municipal bonds, government obligation bonds, revenue bonds, conduit bonds, U.S. Treasury issued by the Department of Treasury, Treasury bills, Treasury notes, Treasury bonds, and tips. If you ever wanted a good little example on how to know the length of bonds, it's James Bond buys notes from bills. Oh, sorry, I got that wrong. Bill buys notes from James Bonds. There it is. Bills are the shortest time, buys notes from James Bonds. So bills shortest, usually a few days, 52 weeks. Notes are maturities that secure within 10 years, and bonds are anything longer than 30 years. So, and pays interest rates every 6 months. And don't worry, I'll have this slideshow ready for everyone once it's done. It's in the works right now. I'm doing mentorship here more and more in Fresno to teach people the stock market, and this is the presentation that I go through when I do live groups for them. You may have noticed a couple more new community members here from Fresno. That's the slideshow I usually give to them. So just keep that in mind. With that being said, let's go take a look at the index. That's enough harping on that. So looking at the S&P 500, let's go just erase all these lines here. You can see that we dipped down pretty heavily today. Now remember, October has the biggest chance of a surprise. Of the months that have the biggest down move or the biggest surprise in movement, it's the end of September, the middle of October. Typically, those are the times of years that if the stock market's going to do something of surprise, it's in those time frames. And now I'm not saying this is a pretty big down move. It is a significant down move, where I mean we are down 1% today. But overall, for trend-wise, we're not entering a bear market yet. We are still touching the bottom part of the 287 in this channel. If this channel holds, it could recover back into the 291. Now, if we do fail to hold the 280, there are significant times this year that every time we dip down below this 280 level, we've moved right back down to the 278. So keep that in mind. We did see that the Bollinger Bands were compressing, and now they are moved out. Typically, you trade the way in which they break up or break down. They are breaking down here. We are moving into third quarter earnings, and a lot of tech companies are going to report on the 25th. I believe Microsoft, Amazon, Facebook, Google, they're all reporting on the 25th this year. And if you want to see that for a fact, let's go look right here and I can show it to you. Microsoft, 25th. Amazon, the 25th. Google, who usually likes to report on a Tuesday nowadays, I think it's going to be the 23rd or 25th as well. So there's a lot of companies, big companies, that are going to report that Thursday, 21 days from now, or 3 weeks. So understand there's going to be a little bit more volatility inside them as well. Sorry if my voice is a little scratchy. It just rained for the first time yesterday and the day before, so a lot of stuff in the air. A lot of stuff finally coming out from all this summer smoke. For the S&P 500, it is really light on implied volatility right now. You can see that we finally got an uptick in the S&P 500. We're at 12% implied volatility, and now we're at 16%. It's not the best time to be long volatility just yet on the indexes, but it is expanding, so just keep that in mind. Your long Vega trades right now still outperform your short Vega trades in a rising Vega environment. That rising Vega can be the what's happening in the bond market and the squeezing in liquidity. So keep that in mind. If we do fail to hold here, it's a pretty big dip back down to 280. So keep a watch here. It does look like it is retracing a little bit. It could find a little bit of stopping point right around the 285. If we were to throw on a Fibonacci retracement and we were to use right here this 268 as our low, and we didn't move right here, and we go to the high of the year, you can see about 283, 281, and about 278 look to be about the 38, 50, and 61 retracements, or the typical areas in which in the Fibonacci they like to grind out at there. So keep that in mind. Is it the time to put on short volatility on the S&P 500 and the indexes? Not yet. Long Vega trades are typically a little bit will perform better than those trades right now, so keep that in mind. If there is a continued rotation out of equity into bonds, it could get very choppy here. The S&P 500's dividend is really light, the dividend yield, as opposed to what you can get in bonds. Why do I have to worry about, if I was fixed income, why would I risk about a market that's been overextended for a period of time and having a dividend that's compressing when I can just buy a bond and just get a dividend there and not worry about a risk of a stock market collapse. So, something to think about. Now, if we do retrace here on the S&P 500, I'd look to right here is the next level to retrace back to, is the 291. Remember, we are moving into earnings, and a lot of companies cut their forward guidance last quarter and the quarter before to get those EPS numbers to look a lot better. We are seeing a little bit of a slowdown in EPS, and with share buybacks being 30% of the overall upward movement in the S&P 500, which, by the way, first quarter was $100 billion, second quarter was $400 billion in share buybacks. Share buybacks are going to start slowing down as interest rates move up, so keep that in mind. In a rising rate environment, when you are a company that did a lot of share buybacks, when you can no longer perform on your EPS, when you no longer show growth, it's going to be a lot worse for you because you have a lot less shares to dilute that number to, and so you have to continue to give these good numbers on earnings, and if you cannot do that, you're going to have a pretty bad downward movement when you finally can no longer perform. You're no longer buying those share buybacks. So that could be a problem down the line. Not going to happen maybe this year, maybe next year. It might be a big significant problem once the economy starts to overheat a little bit and the Fed starts tapping the brakes, so keep that in mind. Also, if you are a large company with a huge share buyback program with a high pension obligation, once your pensioners start to withdraw from your company, once they start selling their stocks and you're no longer doing the share buybacks, it's going to get very ugly for that company as well. So that's another thing you want to keep on your radar for now. When share buybacks for high pension obligated companies start to annuitize, start to draw from their pension, it could be a problem, so keep that in mind as well. Is it going to happen this year? Probably not. Baby boomers are about, the youngest baby boomer turned about 53 this year, so you have a couple years for that as well. So there's something you want to look at towards the future. Now next up, let's go take a look at the IWM. Now the IWM has had a pretty ugly rotation lately. Now the reason for this rotation could be because of tariffs, because of trading. Canada and Mexico came to the trading table. We have a new NAFTA. With that being said, you no longer can sell your products at a premium if you're a domestic United States company who strictly does business inside the United States. They don't trade with Canada, they don't trade with Mexico, they really just sell to the United States consumer, and they were able to charge a premium because tariffs were a little bit higher, trade was really wonky, and that there was uncertainty there. And as Canada and Mexico has come to the trade table, maybe the tariffs on China might calm down, though after this chip fiasco, it's probably going to escalate because of that. There's been a rotation out of domestic United States companies back into the global companies, and so that is reflective in the IWM, and you can see the rotation there. Once Canada came to the trade table, once Mexico came to the trade table, you can see that the Russell has gotten hit pretty hard, and it's most likely going to continue to move down to the 162. You're going to give some forward guidance. It's going to be cut this earnings cycle because they can no longer sell that product at a premium. So, you expect a rotation from the Russell. It did pierce below this long handle, this long area of the 164 support. So, if you are long the Russell, and you've been profitable all the way down from here, might not be bad to start looking to put on some protection, or maybe looking to take some profit. Now, if it can hold this area, the 164, there is potential to move back into the 167, though there is a nice rotation from small caps back into the global companies, so keep that in mind. If we go look at a heat map of the Russell right now, you can see it's pretty much red across the board. Industrials are going to get hit really hard. Materials are going to get hit really hard. Utilities doing okay. Telecom's doing okay. Consumer discretionaries are going to get hit a little hard here. Now, as liquidity starts to dry out, The Federal Reserve is no longer going to banks and saying, hey, we're going to buy your bonds, and with that money you can go out and buy more bonds, and they keep money flowing that way. When the Federal Reserve says we're going to move interest rates up, we're going to be a bond seller, not a bond buyer. That means that inflation most likely is going to go up for the consumer. And with inflation moving up and wages kind of moving sideways, and we're all at all-time rent, all-time housing prices, all-time food prices, all-time auto prices, all-time insurance prices, they're going to get squeezed enough to where consumer discretionaries are going to start feeling the squeeze as well. So keep that in mind. If consumer discretionaries give out guidance this quarter, it says, no, we actually saw a kind of a slowdown in consumer spending, that is kind of a red flag you want to continue to watch here. As the consumer continues to get squeezed from every end possible, it could be a problem for this sector here. So if you are long the consumer discretionary sector, it might not be a bad time to maybe start looking for an exit as well. This will be the red flag. Consumer staples will do okay. Consumer discretionaries, this will be the red flag right here if things are starting to slow down significantly. It will be also in tech, but consumer discretionaries will be a big problem as well. Home builders are starting to feel the pinch right now. Home prices have come down, and which is really interesting. Now I can show you that real quick. You might be saying, Jake, why are we going to your Facebook? Well, I saved it on my Facebook. By the way, project with the kids last night. Melting crowns. Here we go. So home prices, medium home prices, are already starting to feel this pinch here, as you can see from right here. Since the start of this time last year, prices have gone down in the medium home prices, and inventories are starting to build up again. So keep that in mind. So consumer discretionary is where you want to keep a watch for this market overall. The IWM is not quite there on implied volatility, but getting close at 37% implied volatility percentage, and you can see it is kind of moving up here. So it does look like it's starting to become the time that you want to be Vega neutral in your trading in the IWM. Not short Vega, not long Vega, but Vega neutral. Typically when it hits this range is when you want to look at that. Now implied volatility is absolutely moving up. It's moved up from all the way down from 12% all the way to 20%. So that's a nice 5% move in Vega, and we are moving into earnings where they might be a little bit wonky here. And as you can see from right here, volume is not declining, it's picking up in this downward movement. It did kind of move down today, so that is a problematic sign as well. Price and volume, what you always want to look at when you're looking at a shift in the trend. Now, stochastics are telling us we're a little bit oversold here. The histogram, the MACD, is slightly trending down on the daily. On the weekly, we still have a little bit to go on the stochastics. On the monthly, we're still overbought. And then again, we've been overbought for quite some time for the stochastics. And this is a 14-day stochastics as opposed to a 21-day stochastics for that. But the 14-day stochastic you typically use for your daily and weeklies. So you can see there is a little bit of a movement we can get there. And you can see volume has picked up right here on this weekly candlestick. Now, this is Thursday, and we do have significant candlestick pressure, or sorry, volume pressure right there. So keep that in mind, the IWM. Not quite there to panic yet. I mean, this has only been a nice decline off the top, and this is kind of healthy if you are looking to get back in. Typically, you want to see sell-offs like this, but I'm warning you now, there could be a rotation because of United States-based companies can no longer sell their product at a premium because of the new trade agreement with Canada and Mexico. So keep that in mind. That is one risk that you definitely want to keep in mind when looking at the Russell. Next up, looking at the Qs. Now, how do you feel about the small cap companies? Do you think that they're still going to see a premium because of tariffs with China? Do you think that this is a rotation? How would you trade the IWM right now? It'd be interesting to see that in the chat. Going to the Qs now. As you type that in, we're going to look at the NASDAQ here. You can also time in on the NASDAQ as well as we go over it. As we go into earnings, again, a lot of big earnings are going to be reporting on the 25th. You had Facebook and Google both reporting on the same day. I am still bearish on Facebook. Oh, sorry, on the 30th. They'll be 5 days after, so next week. I am still bearish on Facebook. There's a lot of regulations coming out on bots, on Facebook bots, on automated bots on the social media platform. They are seeing declining in revenue with advertisers. And there is news that a little bit of trial balloons of regulations on what you can advertise and how much you can advertise in that space. So what you can and who you can and what you can advertise. So remember in the 70s, 50s, how there are tobacco ads all over the place. They're on vending machines, and now you don't see that anymore. Now to buy cigarettes, you have to go to someone at a front desk, and they have to go get a key to get them out of the lock cabinet in a safe downstairs in a vault. Well, there's a lot of regulations on that reason why you don't see that on billboards anymore. And what you can advertise to people is heavily regulated, and social media has been very free from that space, and it's going to be becoming more and more relevant that they are going to get regulated in that aspect. So keep that in mind. The Wild West, as I said yesterday, finally had the train run through town, and the city folk are actually showing up. So that means you got to start regulating things. You can no longer put turpentine in the whiskey, and you can no longer moonshine sometimes. So that's what's going to be problematic for social media, and Facebook makes a lot of their profit from that space. They make a ton of their money from advertising. 92.5%, and they make a lot of that traffic to advertising through bots. You ever wonder how Facebook has over 3 billion users, but there's a lot of people who don't even own a smartphone on this planet? How are they continuing to grow in users in that aspect? It's bots. They have a lot of bots on their platform, and the state of California, Jerry Brown, passed regulations on bots on social media. You can't have any more. So you're going to see a potential decline in their usership because bots direct people. Now, bots aren't a problem. Bots will say, hey, this person's looking at how to build a website. Hey, this person's interested in this. Let's get these people connected together. And bots are neutral in this situation, but they help drive traffic to Facebook. They help get people engagement up. So they help keep you there longer, and so by cutting bots there, you are cutting engagement, and you're cutting the way that they're able to kind of drive traffic, and that's a problem for their advertising as well. So bearish on the space for this earnings cycle. It is one of the big companies here when it comes to the overall makeup of the NASDAQ. Remember, Facebook is one of the big beta weighters inside of that area. The larger your market cap is, the more weight you have on the overall S&P 500 and the other indexes in which you're in. You can see Facebook is currently the 8th largest. Berkshire Hathaway actually beat it, so that's pretty cool. So I am bearish on the space and going to continue to be bearish on the space, and I'm bearish on Google. Both these are going to get regulated in the same way, so kind of be a problem with those. Huge down move today, touching a very important area. Broke the channel that we've been in, this upward channel that we've been in recently. We broke it today. The upward channel should look something like that, and we did break it. So we did have a trend channel break. So be very careful on the NASDAQ. Now the NASDAQ typically has higher implied volatility. It's not quite there yet, but it is getting there. So again, Vega neutral trades will outperform right now the Vega, long Vega, and, well, long Vega will still do okay here because Vega looks like it's going to continue to rise just a little bit. But start to look at your Vega neutral trades right now. Typically, when you're above or at the 40% implied volatility, that's typically when there is some premium inside of that index or indice you're currently trading. We are getting pretty close to that for the NASDAQ. So keep that in mind. The price target for the NASDAQ, if we do not recover the 183, Keep a watch for the 180. If we do break the 180, the next movement right there looks to be about the 177. Again, we did break this upward channel, so be very careful here on this index. I do believe the NASDAQ is leading the way down today. 1.94%. Yeah, it does look like it is retracing though. So if we were to go to a 2-minute chart of the NASDAQ, what does it look like right now? Not bad. Big buyer stepped in right there. Keep a watch for right here. If it could sustain, what am I? Right there. That's where you want to keep a watch for, right there. If it can break above the 182, it looks like it could potentially move back all the way to the 182.64. If it fails to hold this, and you can see this is where the downward trend kind of stalled and continued and picked up speed right here. It looks like we might see a little bit more downward action. So it does look like some shorts are covering right now. So be kind of careful right there. If it fails to sustain it. That looks like a lot of short covering right there. How do you decide when the downside is over? So for Facebook, once regulations comes in, once they show usership is starting to move sideways or starting to pick back up again, is when I'll start being bullish on it. Once regulations do come in, now the regulations haven't even been trial ballooned out yet what they're going to regulate, but there's talks of them, and that is enough to kind of shake the market. You want to see Facebook kind of sustain this 157 level. If it can sustain it, there's a nice cause to get it back to the 166. The CFO and COO both talked about decline in revenue from news sources because of the election. They're restructuring that, or also known as reevaluating, rebuilding their algorithm to get people to the right places. And they talked about that 3 quarters ago. And you can see 3 quarters ago, that would be almost this time last year, the stock had a nice little rise. And they talked about that around October. It was, I believe, yeah, it was late quarter, it was September. They talked about that being a problem. They were going to see decline hiccups. They were going to see decline usership. They were going to see a decline in newsfeed revenue because of restructuring that. So keep that in mind. Once they rebuild their platform a little bit, get their algorithm in line to put people in the right buckets again. Remember, when you use Facebook and you say, hey, I like Tiffany's. I really like the store Tiffany's. Look at how cool this Tiffany's jewelry is. They have an algorithm that says, this person really likes Tiffany's. Let's A, advertise Tiffany's to them. B, let's put them in a bucket with a bunch of other people that like Tiffany's. So if you might see, hey, this person, you haven't talked to this person in quite some time. Why don't you become friends with them? And then it will put you in a circle of a group of people that say, hey, we all like Tiffany's. Yeah, I like that necklace too. And so it'll put you in that bucket, and then it will advertise exclusively to that bucket, and then it will just keep going in that circle. Well, same thing with the news feed. Hey, I'd like to vote this way. I too like to vote this way. Or I'm outraged about this position. I too am outraged about this position. It will group those people together. It will show those people's posts a lot more than other people's, and then they'll advertise to you through those opinions. Now, they have to cut back because of that, and they have to restructure, and it's going to hurt their revenue model. Now, their management team is pretty superb, though they are losing more and more people. I still like the management team here, but understand they might be going through contraction in revenue growth for about a quarter or two, or maybe even about a year of contraction until they can figure this out, because that is a big problem for them. So, long answer for Facebook. So it might take a little bit once you see it declining from them kicking out a lot of bots, because let me tell you now, Instagram, Facebook, WhatsApp, Snapchat, Twitter, Google+, YouTube, they all have a ton of bots that feed for SEOs, for search engine optimization. They use a lot of bots to get excitement up about products, excitement about traffic. And by California regulating that market a little bit more, you're going to see a decline in their usership of that. As regulations become more and more relevant on the usage of bots, it could be a problem for your social media companies. Twitter is in that same group as well. They have a lot of bots on their platform that help drive traffic. They help drive traffic to people's websites, to people's products, and by cutting the bot traffic, you are cutting revenue growth from them. So keep that in mind there. That's why I'm so bearish on the Facebook stock. But they'll eventually figure it out. Well, now that we looked at our indexes, let's go look at the fan favorites real quick. I do believe I was supposed to write a couple of these down, and I was looking for a pen and I forgot to. So let's go look at these SBucks. We're looking at the VIX. After Amazon, we'll definitely look at the VIX. We'll look at the VIX v SBucks. And that looked like the ones we want to go through. Alright, so first up, let's go look at Amazon. Now, Amazon, understand that this story right here is a big deal. If it's true, and it does look like that is the case, because there was also a source out of Russia that they discovered the same thing in their servers. Now you might be saying, oh, Russia, Russia, Russia. It was from a totally different news source in a totally different area of the world that came out with the same story about a couple days ago. So that is a big problem if you are a big provider of server infrastructure or products of hardware, because that hardware is going to have to be replaced. Not only is it going to have to be replaced, but you have to take that hardware down to go investigate that, because once that chip is discovered, you can no longer use the hardware that chip's installed, because that chip will corrupt code. It will allow access to things it's not supposed to. It will be able to infiltrate other people's products that might be really secure. This chip allows the kernels to be recoded in such a way that it allows permissions, and that's a big issue with that. If it was just a software issue, say that these motherboards had a innate software attached to them, you can just rewrite the code. You can put it in a patch. You can say, okay, no, this code is no longer allowed, or it strips the code out of there. But once there's hardware on there that restructures everything around it, it's hard to fix outside of just replacing it completely. That's a big problem. And so Amazon is going to have it's going to be a problem for Amazon to fix. That's one of those things. It's oh, you do this and you have this type of problem. It's going to be significant to Amazon, and how they fix it, it's going to be interesting. It does look like it kind of peaked right here around the 2028. It did come back down the important level of support around the 1900. If the 1900 does break, it does look like the 1850 looks to be the next area of downward action. Now, if we can hold this area, it might recover back to the 1953. But again, that's about a $50 swing in one day. That's a huge ATR. Volume is kind of picking up here, but it's not huge volume. This is going to be a big issue, though, for Amazon. That news story that Daniel posted up there. I was reading it pretty closely, and if you are a cloud-based service provider, your servers are going to have a big problem if you did buy motherboards from that company that installed that chip. Now, who was another company that could get hit really hard? Microsoft. Microsoft can get hit hard with this news too. 3 of their top 5 holdings are server-based products. So if they do have any of those motherboards inside their servers, it might have corrupted the whole server. So Microsoft might be another one that get hit here as well. Just because Amazon and Apple discovered it doesn't mean it's not in other contagious areas. So you probably want to be a little bit cool on the cloud space and the server space for a little bit until that issue gets resolved. Sorry, it's time for water. So keep a watch on Amazon. This is a nice candlestick that it did form right here, because this candlestick is within 2 ranges. It's between the support and the resistance of the previous time it tested it. So you want to look at it either break down or break above. Now if we go look at the 2-minute chart of Amazon right now, it should give us some guidance of which way it could be heading today. You can see again, shorts came in, or sorry, shorts squeezed a little bit here. So it is kind of chopping out right now. I would keep a watch for right here, a break above 1914. If it can break above here, it does have a nice case to get back to the 1927. 78% implied volatility tells us that there is a ton of implied volatility in this stock right now. Absolutely huge implied volatility here for Amazon. You can see it is going back towards the highs of this year. So if you are short options on Amazon, understand that there is a good case for volatility to potentially wash out here, but understand that it could potentially go a little bit higher, so you're going to feel some Vega pain. If you are long options in Amazon, understand that volatility is really high, so you are buying options at a huge Vega premium, Vega being the option Greek of implied volatility. 1% move in implied volatility equals that much a percentage gain or subtraction inside of that option. You are buying a lot of Vega right now in Amazon options. A lot of Vega. So if you are long these options and Vega were to wash out, a lot of your profit could evaporate because of that. So understand that. Amazon could do, you say you buy an at the money Amazon call right now. Let's just go, let's go, because we're crazy and we're not looking at too much of a Vega risk. Say we bought the at the money 106 day out Amazon options, and oh my goodness, are they expensive. If we go look at Vega, let's go look at the actual implied volatility inside these options. 30%, not too bad. Not too bad here. So the further out, 34%, not too bad. It's a little bit high, but that does tell us that there is some Vega to come out of there. As you can see right here, Vega is adding about $4 to these trades. So if Vega were to come out, say wash out 15%, that's a significant movement in that option, in its price. Now if we were to go to like your 8-day options and look at the money, let's go look at the actual implied volatility, 30% here. So if we get like a 10% move washout in these options, you're going to be looking at a Vega taking about $10 in implied volatility out of these options. So that would cut it down from 37 to 27. Now if Vega moves up another 10%, that would add 37 to 47. So understand there is a lot of Vega in these options right now. So be very careful if you are trading Amazon options. Amazon options, there are Vega. Vega is definitely relevant right now. Overall, though, again, if we look at the Vega trade, you can see it's 29% and 30%. Amazon has been a lot higher in the past. You can see it's gotten up to 40%, 45%. So if it does peak above this 40 area, it could potentially go up to the 45. So be very careful if you are trading these option-wise in Amazon. There is significant vega where this trade can shift either way. It could go in your favor or it could go against you very quickly. And we are moving closer and closer to the earnings time. We are about 21 days out. Typically, Amazon likes to rise in implied volatility about 30 days until its earnings event here. It does like to expand anywhere from 30 to 3 months. This is a really kind of hard one to kind of pinpoint when the rise in implied volatility is, but it typically does rise going into earnings, and then it washes out. So this is a big issue for Amazon. You want to keep a close eye on this if you're long their options. Be careful. Next up, let's go take a look at the VIX. I talked about yesterday and earlier this week, the VIX is a little bit oversold. It dipped down below 12 here, didn't hold it, and now we had a nice movement back up here as the stock market is rotating. Typically, the VIX likes to move between these two areas, 12 and 14. The VIX likes to move above 12, then to 14, it likes to move above it, then it moves back down, and then it likes to settle back at the 12. We are below the 12 handle, so typically that tells us that once it settles, it should rise a little bit, and the VIX did pick up from there. Now, if there is a bigger market rotation and people are looking to buy protection, remember protection is pretty cheap with the VIX being at 11.9, that tells us there's going to be some put buying. The VIX is the call to put ratio, the S&P 500 30-day contracts. That tells us people are looking to protect their position as well. So this market sell-off, not only did we move down 1%, but we saw people buying portfolio protection too. So that means people aren't selling their position yet, they're protecting their position. The VIX did get back up to, I believe, the 15 handle earlier today, almost 16, and then it came back down. You can see the VIX is coming down pretty steadily here. After a 1%, 2% down move, recently this market seems to like to just round back up. So keep an eye on here. It does look like the VIX is coming down. Now this could just be warm-ups to the VIX moving a little bit higher. So kind of be careful on that. If we go look at the option chain in the VIX and we go look at open interest for this week and next week, you can see that not that big of open interest going into this Tuesday's options expiration. You can see that next week actually has a large option expiration. So about 2 weeks from now, it's going to be the big VIX rolling that might potentially happen. You can see hundreds of thousands here, and if we go to the week after that, you can see back to the 100s. If we go back there, hundreds, 0. Let's go back to the next front month options. You can see right there 47 days. So about 2 weeks from now, we could be seeing it pick up in these price of these options, which tells us there's a lot of liquidity in these options too. If you do plan on trading the VIX right now, these options you can buy and sell them pretty easily and get out of it just because of the open interest here. Nice volume, usually. So not too bad here. I did close my VIX trade today. I closed it for 60 cents just because I didn't like it where it was. I opened it for 65 cents, so made a little bit of a profit. Keeping a watch here on getting back into it. I was a little concerned on the VIX movement, so just took a profit and walked away. Remember, never be afraid of taking a profit, even if it's just $1 above there. Now, the SVIX, I did buy around $56. I did close my 59 call, and I opened up another 57 call here. If it gets called away here, I'm okay with it. The SVIX, remember, is the inverse VIX. As the VIX moves down, the SVIX moves up. I did have it about 56, so again, I just opened another covered call. I would have made a little bit more money in the next 8 days, but I'm still making some money here, so I'm pretty happy with that. So the SVIX might see a little bit downward action. We also have the UVXY. The UVXY and the SVIX recently split. Volume did pick up on the UVXY. Remember, on Wednesday we'd had volume around volume was around 9 million, and now we're at 21 million, so pretty good here. The SVIX has a little bit of premium added to it, so you can definitely look here if you are doing some SVIX trading, some UVXY trading, so keep that in mind. A quick rundown of Vega. Yes, I can do a quick rundown in Vega. Let's see here. Let's see if it's this one. Who knew I had a PowerPoint and all the Greeks? Now understand, Vega is probably one of the most important Greeks inside of options. These are Vega trades. Let's see here. Okay, that's all I got for Vega. Okay, I got rid of it. Vega is a move. A 1% move in the underlying asset will add that much premium to the options. So, if Vega moves up 1% in the stock, it will be represented in a price movement here in the option chain. So, here's Vega right here. We're looking at UVXY. If implied volatility moves up 1% or down 1%, it will add 2 cents to this option right here. Implied volatility is described as the uncertainty in price action in the stock. The stock, or the forward uncertainty in the price of the stock or the option. So if there's 1% more uncertainty in this stock and the implied volatility rises, you'll see it'll add about 2%. Not 2%, 2 cents. So again, Vega is just a 1% move in the implied volatility in the price of the option. It'll add that much premium, or it'll be represented in price in the premium in the option. Whew, a lot to say. Vega is probably one of the hardest option Greeks to grasp next to Rho, but it's one of the most important when it comes to selling and buying options. All of these are important, but understanding of Vega and Theta are very, very important in option trading of options. If you're if you like to sell premium, Vega is important. If you're a swing trader, Delta is important. So is Gamma. If you like to sell options or just trade options, Vega is also important. So usually the two conflicting are Vega and Theta. These two like to conflict with each other. This always happens. Time decay happens. This will add premium to the option. Means that Theta now has to decay more to get those options down. So that's a basic rundown of Vega. Sorry if I went around a lot for it. So next up, let's go take a look at not Verizon. I always confuse Verizon and Visa. Always confuse these two. Ooh, Visa's having a nice down run as well. Companies aren't very happy with Visa and MasterCard right now. Stretching my mandula. You're welcome. Remember, this video is recorded, so you can go back to me bumbling around Vega more and more and more. I thought my slideshow had more. Apparently this is the older slideshow. I'll have to find the other one. If you are coming back to revisit this video, by the way, and you're wondering, should I be Vega positive or Vega negative? Here is a cheat sheet of Vega positive trades right here. What typically does well in a Vega positive environment? If you think Vega or implied volatility is going to go up, what trades typically do well? Your long calls, long puts, covered calls, bull call spreads, bear put spreads, calendar spreads, long straddles, long strangles, short iron condors, ratio put, back spreads, ratio calls, back spreads. So if you're like, I wonder what does well in a short Vega environment, or a negative Vega environment, well, here's a cheat sheet for that as well. Bear call spreads, bear put spreads, butterfly spreads, long iron condors, short straddles, short strangles, short puts, short calls. Now, just because a short call and a short put does well in a negative Vega environment doesn't mean you should put that trade on. It just tells you what trades typically do well in that environment. If a stock is continuing to move down and implied volatility is really high, it's probably not a good idea to put a short put on a stock that's falling. If the stock is rising really sharply and implied volatility is also going up on it, and it's already been very high here, probably not a good idea to put a short call on a stock that can go up in limited price. These are just telling you, typically in these environments, what trades perform well. It's not telling you to put these trades on, it's just telling you which ones are in these environments will do well in those environments. But you always have to look at the underlying asset, equity, commodity that you're putting them on and understand how each one of these works when you do put them on. A stock that is falling significantly is not a good stock to put a short put on. Not a good stock to put on a strangle or straddle on. Oh, one side will do good. So understand these are just trades that tell you Vega is rising. Okay, these typically do well in those environments. It doesn't tell you to put them on. It just tells you which ones do well in them. So just keep that in mind. I know it's a bit confusing, but understand that. Understand that you still have to do charting when you put those trades on. So looking at Visa, it does look like it's on an important level of support right here through 146. It does look like the old area of resistance right around here is becoming a new area of support, though it did break that channel pretty quickly. So keep a watch right here for the next movement down. It does look like it is retracing. It does look like it's jumping off the 25-day moving average. The histogram of the MACD is downward trending, so that's kind of a problem right there. The stochastics are moving back to neutral, so keep a watch on 146.71. If it does recover, it does look like it could potentially recover back into the 149 handle. Visa has earnings coming out. Let's see here. The 24th, so that Wednesday. Looks like the week of the 25th is going to be a pretty volatile week. There should be some volatility creeping up into the 15th, into the 22nd, so be very careful these 2 weeks here. Volatility should be picking up significantly as we move into this earnings cycle. It does look like it is still in this upward channel here. Let's go back to Wall Street and let's go look at the channel. High implied volatility depends on the stock. Typically, when I look at putting on options trades, I have this little indicator right here above here, IV percentage. When it's above 40, it typically tells me it's high volatility for that underlying asset or equity. Now, just because you can see it's at 19% here, look at the actual implied volatility. It's at 21%. You can see in the actual implied volatility, it still has some move to move up here. Now, you might be seeing 20%. That's not bad implied volatility. Well, let's go look at Amazon's implied volatility. We're at 77% implied volatility percentage. It's at 40% here. Notice how this moved up significantly here, and we're only almost double the implied volatility, still only at 41%. Pretty high volatility. Let's actually go look at insanely high implied volatility. This is 107% implied volatility on the stock, and the IV percentage is currently at 9. So it's really relative to the asset you're trading. What is considered high implied volatility for it? A stock could be high implied volatility at 10% relative to the stock. It really depends on each individual stock and what high IV is. So keep that in mind. Typically 40% though is still pretty high implied volatility. If we actually go look at an option change. Yeah, good question. Good question. Sorry I'm getting derailed a little bit, but it is a pretty good question here. Remember I said Amazon has some high implied volatility right now. Even though it's 30%. So let's scroll down here. Scroll back. Alright. So we're looking at this right here. 31%. Well, I'm not buying that. No. Gotta be careful with that. This is high implied volatility relative to the stock. And you can see implied volatility kind of goes up in this chain here. So just keep that in mind and use your own metrics for it. You can use implied volatility and historical volatility as a guide for that. Now, we can throw in a study here. We can throw in historical volatility. All studies. So this is historically the implied volatility that Amazon is at. Now, historical implied volatility is the actual implied volatility. Implied volatility is the uncertainty, or is the, well, it could be here, volatility. So this is the actual implied volatility at 22%. Historical is usually more accurate to what the stock is currently at. So keep that in mind. And I'm probably butchering this, but yeah, Tilray had huge IV. So you want to keep a watch on that. Let's see, what am I doing on time? Sorry, I didn't get a good description of V. So keep a watch on these levels. Cryptocurrency is currently, and blockchain is going to start wearing away on some of the profitability on Verizon, on MasterCard, on American Express. Why is that? Well, blockchain doesn't charge you a percentage fee when a customer uses your product. So that's a big disruptor for the credit card industry. Whenever I use my credit card at Target, if I use a Visa card, Visa charges Target 3% of the transaction fee. Doesn't happen with cryptocurrency. Doesn't happen with blockchain. For some. And that's a big problem as retail sectors wants to keep more and more of their profit and give less and less out of it. It could start to eat away on Verizon. Not Verizon. So you see how I always confuse Verizon and Visa? VZ and V? You understand why I get mixed up. Visa, Verizon. You know, Visa has more of that VZ sound. Anyhow. So keep a watch on this. It's still in the upward trend though. It's still a nice upward channel here in Visa. It is touching the bottom in that range though, so keep that in mind. If it does break this channel, it does look like the 144 is the next in play. Last up, let's go take a look at Starbucks. And then we'll wrap up for the day because I'm starting to lose my voice. As a general guide, you buy low volatility, you sell high. That is a very good guide. When volatility is low, that's typically when your long volatility trades do well. When volatility is high, typically that's when your short volatility trades do very well. There are stocks that you can do that you can build a plan around just on trading low volatility to high volatility. A good one to look at is, I believe, PA and W, Palo Alto Networks, is really good. Okay, implied volatility. No, there it is. Bam. This is a good stock to look at. Every time it goes into its earnings, these are earning waves. You can see that in the implied volatility expands and then it crushes out of here. So typically 30 to 40 days between its earnings event, volatility craters, and then it starts to pick back up. And then this is when you start to look to do long Vega trades, and when it gets to the height of its earnings is when you start to look at short Vega plays or getting out of the long Vega trades. So stuff like that. Very true as well. Look at this nice discussion that we're having. It's also important to look at IV at different expirations. Expirations following up and coming earnings have significantly higher IV than options prior to the earnings event. These are very good insights as well. We are going into the earnings cycle as well, and that tells us that volatility is going to be picking up going into those options. So looking at Starbucks, Starbucks is in a nice channel here. It did violate it a couple times. It does look like it is basing. I believe Starbucks is buying a company. I'm not quite sure on this. I lost news on Starbucks here. overall, it retested the gap right here, and it does look like it is continuing to rise. Starbucks, I believe, has earnings coming out later this month. Yeah, next month. So keep that in mind. Implied volatility should start picking up here. Starbucks is one of those companies that does follow implied volatility waves, but it takes about a month and a half for their waves to start moving up here. So keep that in mind for Starbucks. I lost all my charting here. Implied volatility looks pretty good if you're looking for an option play on Starbucks. It doesn't look too bad. We have this gap that got tested right there. It failed to sustain it, moved back down, so it actually moved back down to the top end of that gap here, and then it sustained it, moved back up. So this does look like we have support around the 55.15 level here, right where the gap touched, and it does look like we are kind of bouncing off of. We had a nice range upward. You can see nice upward action, then a sell-off, nice upward action, then a sell-off, nice upward action, then a sell-off. This is a very healthy chart right here. Then a big rise, and then a kind of a sell-off. So I would keep a watch right here. And if it can pierce above here, we might be testing this gap on SBUCs. Yeah, earnings are always a volatile time of the year, and a lot of things can go wrong with a lot of trades through earnings. They might surprise the market and say, hey, we're going to cut our earnings 2 days before the earnings event, or hey, we're going to remove our CEO, or hey, we're going to buy this company, or hey, we're going to do this. Earnings are very, very volatile events, and if you're not very used to them, it's not a bad idea to sit sidelines and just watch them and study them. And you can also, most trade platforms have the ability to go back in history and time, and you can watch the event happen. You can watch the stock move up and down. You can trade the time there and kind of get a little bit more verse in them. Usually what you want to do is you want to pick like 5 or 6 stocks, and you want to track them pretty rigorously and watch their movement through earnings and track their guidance. And then you'll start to get a pretty good feel of it for that. But yeah, it's not a bad idea to sit sidelines for earnings because they can definitely have significant events here. How am I doing in time? Oh, all right. Really quickly, we'll go through the dollar, and then we'll wrap up with commodities. So looking at the dollar is continuing to rise here. You see a little bit of weakness in the dollar. Now what's interesting is we saw a nice movement in the dollar, and we saw a nice movement in gold, and now gold is coming back down into this range. Gold is very interesting here. It's going to be volatile. If you are a gold trader, understand it's going to get wonky here for your mining trades. If the dollar continues to see strength here, I would not want to be long the miners right now. You can see a nice rise up here with the dollar weakness, but as the dollar continued to move up here, you should have seen some weakness in GDX, and we're not really seeing that yet. So there is a deviation in this miners. I'd be very careful here. Very careful. Also, oil has gone up as well with the dollar. Sorry about that. And it is coming down a bit. Now, EIA petroleum status showed a significant buildup this week. We are moving into the time of year when companies move from their winter blends to their summer blends to their winter blends. Winter blends are more profitable for them, so it could be good for these companies going out, but we are seeing a significant buildup again. So that's something you want to be worried about. 8 million barrels is a real big problem. 1.9 million barrels is kind of a neutral number, but anytime you see above 5 million barrels, it's kind of something you want to keep a watch of. We saw a significant rise this Wednesday in storage in oil, and oil continued to move up. That's a problem here. I think oil is very overextended. Very overextended. But if it continues to rise here, what are we going to look at? What are the channels to look at? Even though I think the movement in oil is a little irrational, the market can be rational longer than be liquid. So let's look at the channels in which it can rise to if it continues to move up here. For that, we actually have to go into a weekly chart, and we have to look at from 2014. The last time we were this high was about 2015, and we got to about $16, $17 a barrel, and then it kind of moved down. If it continues to rise here, there is a gap to test right here at the 19 handle, 1920 handle. So keep that in mind if we do pick up in oil here. Now, if we do decline here, keep a watch for the 1521. Having a great past weeks. It's going to, yeah, if oil continues to rise here, it could, those are the levels you want to keep a watch in. That's a pretty significant rise in the USO. If oil rises in price that significantly, it's going to be good for your independent oil companies, your smaller oil companies. It's going to be good for the people in the Bakken Shale, the Permian Basin, the Eagle Ford. Going to be very good for them. Though, if the dollar continues to hold this strength here, it's not going to be very good for them. Usually the dollar is strong, oil is weak, and we're seeing a deviation from that, so be very careful on that. That typically means one of the other has to pop. Not significantly, but just a little bit, so keep that in mind for oil. Those are the ranges you want to look at. With that being said, though, and as my voice is going out, I was surprised I was able to make it last this long here. I'm going on I think 3 hours of sleep every night. Last night I spoiled myself, and instead of writing, I decided to go to bed at 2, and I got up at 7. So I was pretty happy with that, and I actually got a nap today, so which was really nice. As always, though, if you've not checked out the University tab in a little bit, there's a great wealth of knowledge in here. Nick is absolutely crushing it in the 90-day roadmap, 2nd edition. He actually added a couple of videos to it. I watched these videos myself, and I'm impressed with the skill that he is laying them out. Very well done. If you are new to day trading and you want to learn a nice method of day trading, Swallock's 4 videos are very informative and very good. I highly recommend them to everyone. I recommend them every Thursday during this meetup. If you are new to day trading, Swallock's day trading classes are very good, so check them out. And as always, this has been your Portfolio Growth. I'm Jake Pelly. As my newborn baby gets older and older and older, I will be more consistently getting back to the market recaps and the Portfolio Growth. So just bear with me for about a month or two, and it'll get back to normal. So that being said, though, have a good rest of your day, everyone, and I'll see you in chat.